So here we go, the most popular video series that I do on the YouTube channel, which is the stocks I'm buying August 2024 edition, and we're back on the whiteboard. I'm back from Italy. I just got back a few hours ago. Well, a few hours ago. I set off at 4 a.m. UK time and just got in now, and I'm recording. Hopefully edit this video and get it up for you guys at 6 o'clock. It's been a long day, so if I don't have as much energy as normal, that is the reason why. But it was a great trip, great holiday. Italy, absolutely amazing food. But onto the stocks I'm buying August 2024 edition. This is the most popular video series that I do on the channel. I go through all the stocks that I bought and sold from the 1st of July to the 1st of August. Now, since then, it has been quite volatile in the market and there's been a few moves made since then, but that will be revealed on the 1st of September for you guys that are on the YouTube channel. Obviously on the Patreon, you get up-to-date information on all that, so just a little shout out there. But yeah, we'll go through what I've been buying and selling, and I've done this series for many years on the YouTube channel, 6, 7, maybe even 8 years now. And you guys can follow along. You can see what I'm buying, what I'm selling. I don't hide anything. I don't buy something and then if it doesn't work out, I sell it out quietly in background and hope you don't notice. Or I don't suddenly turn up and go, oh look, I knew this stock was going to go absolutely amazing. I bought it, now I pay 8%. You know what I'm doing. So you get to see what is going right, what is going wrong. And that's what makes it transparent. And I hope you enjoyed the video. If you could hit the like button, let's get started. Now, if you do want to know what I'm buying and selling in real time, the place to be is on the Patreon. You join through the link in the description. £5 a month. You get to see, like I said, my live buy and sell alerts, which I have actually just trimmed a stock today. And as well as that, you get 2 exclusive videos a week, a Discord with 500 members onto, including me, to talk about stocks every single day. And it's only £5 a month. It's the reason why it's the highest Patreon to subscribe account out there on the whole YouTube stock market scene. I do try to put a lot of information on there for you guys. And if you want some free shares, join Trade Into 2 with the link in the description and you get a free share worth up to £100. Let's get on to the stocks I'm buying. Number 1, you knew it was going to be on the list, PayPal. I did start once again buying some more PayPal. I've been buying this stock for quite a while now. I think it was probably around about a year and a half of being really buying PayPal. And it's not really done anything, which is absolutely perfect because the valuation is staying the same. Even in fact, it's going a little bit cheaper, especially with the share buybacks to have going on. So the valuations are getting cheaper and the financials are just getting better and better and better. The last earnings report from PayPal was enough to make me go, okay, yeah, I need to keep buying this stock because I'm getting a better valuation and the financials are just improving. Like, as long as the financials, you know, what do you need to have a successful business in investment, a successful stock? Profit growth, revenue growth. PayPal is giving you that under the new leadership under Alex Chris. Now, obviously, PayPal is a company that I'm sure most of you guys know, you use yourself. You might use it for buying things, goods online, sending money to people. Businesses use it for some of the services. You also get Braintree, you get Venmo under this platform. It's a mega company. Now, the big wild card that we have with PayPal is the new CEO. So Alex Chris came in from Intuit, did a really good job at Intuit, really good there, and he's looking very good as a CEO. Came in August last year, so he's nearly been there a year now, and he's done a fantastic job. We can actually start judging him now as a CEO, and 12 months in, we could say he is doing a very good job. Now, listening to the last earnings, he still came out and said, you know what? I think we can still do better, which is really good. But the signs of the green shoots are there. He wants to focus on profitable growth, and he is doing that. He's delivering 8% revenue growth, which is very good for a company at 14 times forward earnings. And look at the profitability he's delivering. He recently, in the last quarter, brought a GAAP EPS beat of 0.20 out. That's very impressive, guys. You not only have good EPS beats, but the revenue growth is also very good. Total payment volume, also very good. Now, a lot of people, the negative I always see about PayPal is, oh, but the active accounts is decreasing. Guys, honestly, that doesn't matter in the short term. Hopefully in the long term, that does start going up a little bit more, but you can easily fudge that numbers. If PayPal come out with, hey, join us, sign up, we'll give you $10 free to go spend on something, that active account would shoot up. Would it be successful for the business? No. So as long as they focus on the accounts they have at the moment and making sure that those are active accounts and really focusing on the big spenders there, that is the important thing. And then also what you had there is you had a big hike up on the guidance as well. And something that went under the radar a little bit is they actually then hiked up a share buyback. So they're currently buying back I think it's around about 6 billion worth of stock. For a company that is currently 66 billion, that is a very big share buyback, and they can do that because of the profitability that they throw off. And like I said, you're getting this for 15 times earnings. Guys, in my opinion, a company like this that's doing this growth with this profitability shouldn't be 15 times earnings. These are above market numbers, and yet you're getting it below market valuation. Like, this should be at least 20 times earnings. I could argue the case that it should be 25 times earnings, maybe even 30 times earnings, but it's 15 times earnings. And you look at the profitability they can throw off, they're just going to be able to do more share buybacks as this continues. Look at the growth they've currently got. Very good balance sheet as well. You know, you look at the company here, and the company sit on 59% debt to equity. That is very healthy as well. And obviously, with a good cash balance, we've got the share buyback. They've still got 13 billion of cash, as you can see right there. Yeah, I am really liking PayPal at the moment. It's my third largest position in the portfolio now. Well, it has been for a while, but I've actively keep buying into it. It's still got a way to go until it takes over like Hims and DraftKings, but honestly, guys, the longer this stays down here and it keeps doing these numbers, it could come my second largest, my first largest position in the portfolio. Obviously, it will have to stay down here for another couple of months yet for that to overtake the likes of Hims and DraftKings. But the more I see this, guys, and the valuation isn't reflecting the numbers they're doing, I'm just like, give me shares, and I just keep buying it. And that leads it on to number two. Number two is another fintech company, which is SoFi. So I have been buying some more SoFi shares. Obviously, you guys will probably know SoFi once again, maybe a little bit less unknown compared to the likes of PayPal, but they are a fintech platform in the US. So they are a platform that aims for a younger generation that can get the best offers, the best deals, and get it all under one name. And you can see they mostly started on student finance, which was stopped and only has recently come back. But they also do other things like personal loans, banking. They also do in the investing platform, which is going really well, insurance, travel. And the plan is that, okay, you sign up for one product and then they cross-sell all of these products to you. And the other thing as well is that SoFi have been doing very good numbers in a time frame where the economy has been a little bit slower. Interest rates have been quite high as well. So you imagine if we get a stronger economy, those interest rates come down, that's going to lead people to do more personal loans. And because they go for a younger generation as well, and they don't have the cost of like a traditional bank as well, because it's all online. But because they go for the younger audience, as the younger audience gets older and older and older, what started off as just a private, student loans will then go on to, okay, I'm actually buying my first house. Okay, now I'm going to go buy my car. Now I'm going on holidays. So the big thing is that this customer base is buying more from them and is also spending more on different products. And that's about adding in the tech platform as well, with the likes of the Galileo, for example, which is another big part of this platform as well, which is something that sometimes doesn't even get mentioned. And what you have here as well is you have Antinotto leading this business. Antinotto, who is very good. You ever listen to Antinotto speak, he is a very good talker. He is probably, in my opinion, going to be one of the big names in the finance space in the next few years. And you look at how he talks about how he gives the guidance, how he continues to beat guidance. You look at his pay packet for this, guys. We just talked about Alex Chris being a really good CEO. Antinotto is, once again, another very good CEO. You look at him and he is buying shares like crazy. And one of the reasons why he's potentially buying shares like crazy is because he believes the company is going to do very well, and he personally doesn't get paid that much until the company hits a certain share price. Now, I can't remember what the share price is, but it's something like $30 or $40. So he as well has a big incentive to get this share price going. And if he keeps doing these financials in this environment, imagine what he's going to do in a lot bigger or better environment. Now, the recent earnings, once again, I can't believe this stock didn't go up off these earnings. Actually, the stock was $7 before these earnings, and currently the stock has gone down to $6.55. And they did a triple beat. So they beat on the EPS, the profitability is ramping up massively. The revenue grew 22% in this environment, guys. Very, very good growth. Look at the invest platform. That was up 58%. EBITDA was up 80% here. The numbers are so impressive, guys. The customers that they got was up 41%. You look at the product additions as well. And the guidance, the height of the guidance, a triple beat, guys. And you look at the moment for the EBITDA. And they're now expecting 605 to 615 million in EBITDA. Now, you look at the company right now, and the company is currently 6.9 billion market cap. Now, EBITDA is a bit of a metric that I know a lot of people aren't big fans of, but at the moment it's one of the better metrics we have got because they've only just started making, you know, amounts of profitability. And this company is going to be around about 11 times EBITDA. Now, even if you think it's a poor metric, 11 times EBITDA is very low, especially when you start comparing to other companies that are in the finance space. You're talking, and they grow a lot slower than SoFi, and they're like 20, 30 times EBITDA. But yet this is growing still, this is still in its early stages of growth, and it's doing those sort of numbers. It's very impressive. And you start looking at the company from this inflection point where that revenue is ramping up. Look at the profitability drive. I mean, analysts are forecasting in 2 years' time to be doing nearly 600 million in profitability, guys. This is a 7.1 billion market cap. I can tell you something, guys, if this company gets anywhere close to doing 600 million in profitability in the next 2 years, this isn't going to be a 7.1 billion market cap company. I think you might have to start sticking a 1 in front of this because it's not going to stay here for that long. I think Antinoto's doing a very good job, and I think at some point these triple beats are going to start getting reflected in the share price. And just to show you the inside buying from Antinoto here, yeah, you can see a lot of his insider buys that are going on anyway. I like SoFi. Number 3, Lululemon. So I have once again, PayPal, I think I made a video on it. SoFi, I made a dedicated video on it. Lululemon, I made a dedicated video on it a few days ago, so you can get more detail on Lululemon if you watch that video. But I'll mention it briefly for this series. Lululemon, I have started buying some shares in here. 29 billion market cap, 90 times earnings. Had a very tough year, down 36%. And I looked at the stock drop that it was on at the moment from, you know, when it was at December 2023. It's down 51% since that time frame. In fact, it's actually lower than pre-CV. And you look at the financials since that time frame, and they're way ahead of where they were, you know, pre-COVID. And yeah, I thought, you know what, this has gone way too low. I'm going to buy some shares in Lululemon. A little bit of a risk with it being a bit more of a fashion space, and sometimes the custom base can be a little bit flaky in here, but I thought, you know what, I think the valuation justifies the risk here. And Lululemon, actually, when you look at the valuation, is, like I said, 90 times earnings, but on a forward basis, it's actually down 15 times forward earnings. Now, Lululemon actually normally trades, or has previously traded, at 39 times earnings. Now, they have had a lot more, the growth has slowed down a little bit since then, so I don't expect it to go to 39 times earnings, but this is a premium company, and it's at least expected to be 20 times earnings, maybe even more than 20 times earnings. And if we look at the company, obviously most of it is activewear, gym wear, mostly focused around women, but it's actually expanded into the men category, which is actually growing very well. They've also gone into accessories like bags and shoes, and that's also doing very well for them. The recent financials were very impressive, with an EPS beat by 12 cents, revenue of 10% growth. And let's not forget, this is a time frame when you're seeing like Nike, for example, which is also valued higher than Lululemon. Let me go on the right one. Nike's valued higher than Lululemon. Yeah, maybe the brand justifies maybe a little bit more of a valuation, but I mean, what was Nike growing in last earnings? 1%. Lululemon's still growing 10+% in this environment, which is a lot better than a lot of companies in this space as well. And when it brought out these numbers that were good, the stock actually dropped. Well, actually on the day it was up. You can see it was up 11%, and then it gave it all back once the market opened, which was that was a sign for me like, okay, I'm going to buy some shares on this dip here. And the big thing with Lululemon is that they are doing very well through like the US. Obviously, there's a bit of a slowdown at the moment, and hopefully that comes back strong. But the big thing is China. China is a big area they're going for. And at the moment, China, even in this time frame, is still growing 45% year over year, which could come to half of their business. If that happens, I think we'll see Lululemon double their profit and double the revenue they're currently doing in the next 5 years, which would be a very successful return, in my opinion. Obviously, you know, like we said, really good track record of revenue growth, profit growth. You look at where they were before the CV, the COVID situation, and you look at the performance, and the shares are now at the levels they were prior to the COVID situation. Really good balance sheet here, no debt on the balance sheet. They've got a lot of cash on the balance sheet, which they've been using for share buybacks, which is also very attractive. Yeah, valuation, the growth's good, the China potential is very good. I like Lululemon. Next stock, we've got some Evolution AB or Evolution AB. So this is currently on the Swedish stock market. You can also get a dual listing or over the counters, OTC. on the US listing. That's personally one that I buy on Trading 212 for some of you guys that do ask about that. Once again, I think you're getting good company, good growth areas, good valuation, a dividend. You get a nice little 3% dividend on this one and a really good balance sheet. So when you look at the valuation here, sorry, Y charts, I'm kind of freeloading you here, but it normally trades at 38 times earnings. At the moment, it's currently 17 times earnings with a 3% dividend yield. So very historic low valuation at the moment. Evolution, what do they do? So they provide games like live casino, slots, live poker, and what they do is they provide these games to the likes of DraftKings, Flutter. You can see a lot of the customers that they have down here because they don't want to deal with sorting out a lot of these games. They go, you sort the games out and we'll give you a cut. And they've got all these partners, and they're basically around the world in the UK, Europe, China, Latin America is growing very well. The big one is obviously the US growth. iGaming, the US growth is projected to grow 22% from 2023 to 2024. And that's with only, 5 states online? So there's plenty of states that still come online, and these iGaming states are going to come on for sure, because a lot of states are going to be seeing the profit that they're making, the taxes they're making from sports betting. They're going to be thinking, how do we make more money? Well, let's allow iGaming, and then iGaming is going to get allowed in a lot of states. And obviously DraftKings and Flutter are going to benefit from that. But another company that will benefit from it is Evolution. And it's a bit of a picks and shovel play, because whichever company does very well, this company will do very well because they provide the games for them. It's got a big growth catalyst for the next 5 years, and they've done very well previously. You look at the past performance, the revenues have gone up very nicely, the profit's gone up very nice, and look at the profit margins they do have as well, nearly 50% profit margins. Obviously, as you would expect, they've got a very good balance sheet, as you can see here, and because of that, like we said, that you are able to get a 3% dividend yield. They're also buying back shares. So yeah, I like Evolution. It's a historical low valuation. You're getting a nice dividend, clear growth drivers over the next few years, great balance sheet. Yeah, I'm a fan of this one. And the last one on this list today is Celsius. So yeah, no surprise here. It's having a tough time at the moment. I've had this stock for a while. Started buying in 2022. Did very well. Sold I actually sold my position out. And in the last year, I've started buying back into the stock. Had a bit of a jump up, and maybe that was a bit of an unhealthy jump. But I thought, okay, we might have a bit of a pullback. We had the pullback. And I was like, okay, this is fair enough. And then the pullback just dropped more and more. And it's got to the point now I was like, okay, this pullback has now got ridiculous. Like, it shouldn't be going this slow. And I like Celsius at these levels. 38 times earnings, which a few people will go, that's a little bit of a high PE. But when you look at the growth that they've currently got, I don't think it's a high PE. In fact, it's actually historically the lowest it's ever been at the moment, which is obviously quite attractive. Sure, most of you guys have seen, they do their energy drinks. They've mostly been in the US, but they have just started international expansion through the likes of UK, and they've started going into France, and I think Australia and New Zealand are coming later in the year. Don't know if you've ever had one. I really like them. I prefer them over Monster and Red Bull. Red Bull I found very sickly. Monster, I just feel like the taste is actually quite good with Monster. I just think sometimes you get the big sugar rush and the big come down from Monster. With Celsius, I think you get the taste and then you don't have that kind of big sugar bump up and drop off. I really like Celsius. In my opinion, if you have a Celsius on the shelf, you take it over Monster and Red Bull, in my opinion. So I think they could do very well. The recent earnings were very good, even though the shares didn't really move off them, which was a bit of a surprise. The EPS was a big beat. The gross margin expansion was very good as well on the company. Revenue still grew 23%. Few people are saying, oh, well, it's a slowdown. Well, the reason why it's slowing down is because they can't grow at 50, 60, 70% forever. And as well as that, the big reason that they had the recent jump up is because Pepsi took a stake. They also did the distribution for them. And because they're doing the distribution, they didn't want Celsius to have any disruption because of the changeover. So they took a lot of stock on, and now Pepsi have to go, we just got to balance the stock out, guys. And that's fine. If they still grow at 20% for the next 5 years, this stock is going to do very well. And for what you're getting at, the valuation, this growth here will very quickly grow in this valuation. And also on top of this, what you do have is you have the margins are all expanding because Celsius are doing big scale now. The actual scalability of the company now is making them do bigger profit margins, bigger gross margins. And you don't just have the growth, but the margin expansion as well is going to be very attractive for this company in the next kind of couple of years. And you look at the valuation, I mean, yeah, 36 times forward earnings. If you go by Monster, which Celsius are absolutely destroying Monster at the moment. This is 28 times earnings, but for 28 times earnings on Monster, you only get 2% growth. With Celsius, you're getting 23%. You're getting nearly 10 times the growth here, 11 times the growth here, but yet the P difference is only 10. It's like, well, either Monster's very overvalued or Celsius is very undervalued, and I think Celsius is undervalued. So that says a lot at the moment about where Celsius valuation is at. But I mean, great track record, as you can see here. The profitability, as you can see, is really starting to ramp up on the business now. Great balance sheet. You look at the company, there's no debt on there. They do sit on a good amount of cash, actually, 903 million, and obviously with the profitability they're going to throw off every year as well, nearly 200 million profitability. If I was Celsius, I was quite surprised to see this. If I was Celsius, I would start buying some shares back now. That's the only criticism that I do have of the business, because they've got the balance sheet and the valuation for it. That's the only thing that I would criticize them for, but everything else I really like with it. So yeah, Celsius is also another one that I'm buying. And that leads me on to the stocks that I'm selling. So I did sell some stocks between the 1st of July and the 1st of August. There was 3 stocks I sold. I sold them out completely, not any trims, complete sales. The first one that might shock you is Fiverr. I did sell the whole of my Fiverr position. The reason why is just that I got a little bit worried about their earnings. The stock jumped up big time off their earnings, and I was looking at their earnings going, they were not good earnings. They were like 3 out of 10 earnings, and the stock went up like 20%. So there was, first thing I saw was an unnatural reaction to earnings. The other thing that I had is I didn't like the recent earnings. The growth is slowing down. The Q3 guidance was even slower. I think this company needs to grow somewhere between 6 to 8% at least, and it's not doing that. And then they also expected a rebound at the back end of the year. I don't like companies that are seeing a big slowdown and then say, oh, but we'll be okay by the back end of the year. Because if you get to the back end of the year and you don't do those numbers, you get crushed. The other thing is that analysts are forecasting double-digit growth next year, and looking at the growth they're doing at the moment, there's no way I can see them doing that. The other thing that they did is they pointed out on the conference call that they've seen a slowdown into, I think it was June, and then there was even a bigger slowdown into July. I'm like, okay, that's not what you want to hear. You don't want to hear slowdown and then another slowdown that's getting a lot worse. So the growth is slowing down. Bad guidance in my opinion, and I don't think they can get anywhere near next year's numbers. Active buyers is down 8%. I know it's going to go down because they're focusing on the big clients, which is okay. But the problem is that when you are, and the big AI projects, which I don't know how long-term sustainable that will be, is this big AI projects. But when you're growing your spend by 10%, yeah, it's good. And I don't mind a decline in the active buyers if you're focusing on the big spenders. But I think 8% is a bit too much. I'd be fine with like 3, 4, maybe even 5%. I think this is a little bit too much. The other thing is take rate is going up from 30% up to 33%. And I think this is a big contributor of revenue. If that wasn't happening, where would the company be at? That can't go up forever. The other thing is that some of the growth as well was supported by big increases in sales and marketing this time round. You take that out, the growth was even slower. I'm just seeing a big slowdown in the company. Active buyers going down. The guidance a little bit weak. I just kind of look at the business and I went, you know what? There was other companies like PayPal and SoFi that I was like, I'm just going to put the money in there. So when the stock jumped up, I sold a good chunk of a position. And then the stock did go down slightly. And I thought, you know what? I'm going to sell it. And I did take like a couple % loss, nothing major. I think it was like 5, 6, 7, 8% or something around there. It was single digit, nothing major, and I just thought, you know what, I'm going to just sell it here and I'm going to put it into another opportunity. So yeah, absolutely fine with that. I think I'll do a lot better in PayPal and SoFi, where I think those are better stocks. The other thing I sold was Carnival. I did exit my Carnival position. I did take around about a 30% loss on this one. Probably a little bit less if you do include dividends. It probably would have been around 20% because I have held these shares since 2018, so I would have got the 2018, 2019, some 2020 dividends. So it wasn't a major big loss taken on the stock. But I thought, you know what, I've had this for many years. I bought it before the whole COVID situation, and I'm just sat there with money tied up, and I thought, once again, I'm looking at PayPal, SoFi, Evolution, Lululemon. I thought the money's better in there, so I thought I'd just take a 20% loss on this one. unfortunately never saw COVID coming and move that money into another stock rather than wait for it to get break even. Just move that into a better opportunity. So I think that was a good decision as well. And the last one was Crowdstrike. So obviously you guys know I sold my dark trace position for a major massive gain. Really good performer this year. Put some money into Crowdstrike. It was doing really well. Obviously we had the whole situation came out where they absolutely, you know, self-destructed. And I think I made a video on it saying I sold my Crowdstrike position. I got out, lucky enough, I got out break even at the time because I was up so much, and then it dropped and I was about break even. And then the weekend where that happened, where they had the big outage, I went, you know what, if there's any backlash here at this valuation, the company's going to struggle. So I sold out, and I sold out that one break even, but I think I've already covered that one on the YouTube channel, and that's another good decision as well, because after selling out of the position of Crowdstrike, wow, has that dropped massively. I would be down like 30 something percent right now if I didn't sell out of that position. So a really good decision, and I would buy Crowdstrike again. I'd buy it at the right valuation. What the right valuation is, I'm not 100% sure myself. I ideally had like 180 in my head, but obviously it looks like there's a little bit of a bounce going on at the moment anyway. So unless there's a big fallout and in the next earnings and something really spooks them, it probably won't get there. But yeah, there was also that move. So yeah, those are stocks I bought. Any stocks that I sold as well on the video as well. So hope you enjoyed it. Let me know what you're buying as well. And thanks for watching. See you in a bit.